University of Santo Tomas Taxation Law Review, Pre-Week Notes of 2016, Part 2. Gross Income. The income required to be reported lists income which is by statutory definition or otherwise exempt from tax imposed by law. Except when otherwise excluded, gross income means all income derived from whatever source, including but not limited to the enumeration under Section 32A. Note: NIRC definition is broad enough to include all receipts of money or property unless excluded by specific provision of law or doctrine. The rationale is the lifeblood doctrine. This broad definition of gross income include all passive incomes subject to specific rates or final taxes. However, since these passive incomes are already subject to different rates and tax finally at source, they are no longer included in the computation or gross income in order to determine the taxable income, that is CIR versus PAL. The concept of income from whatever source. The concept of income from whatever source covers income received or earned regardless whether it is from illegal or legal source. Next topic, James Doctrine. James Doctrine. Even though the law imposes a legal obligation upon the embezzler or theft to repay the funds, the embezzled or stolen money is gross income. The rationale: the embezzler has no intention of repaying the money. That is from James versus U.S. The money received under solotio indebiti is income subject to tax. That is from Gutierrez versus CIR. Under the claim of right doctrine, the recipient, even if he has an obligation to return the same, has a voidable title to the money received through mistake. Here's a question here. Miley Ferrer negotiated a check upon a worthless account on USD Bank. Because of such, she received 50,000, which she used to gamble in the USD LaSalle game. The USD won in the game, however, she placed her bet to the DLSU side. Thus, she lost the said 50,000 pesos. On the same day, he received such. The BIR would like to tax the 50,000 pesos as income of Mrs. Ferrer. Is the BIR correct? The answer, yes, the BIR is correct. Following Section 32A of the NIRC, Mrs. Ferrer, the said 50,000 form part of his income derived from whatever source. And for the next topic, classification of taxpayers and taxation of their income. Person. A person for tax purposes means letter A, an individual, letter B, trust, letter C, estate, letter D, corporation. Classifications of individuals. Number 1, citizens. A citizens may be a resident citizen. Letter B, it could be a non-resident citizen. Letter C, it could be an overseas contract worker. Second category is the aliens. The aliens can be letter A, resident alien. Letter B, non-resident alien. In the category of non-resident alien, they can be grouped as number 1, non-resident alien engaged in trade or business. Number 2, non-resident alien not engaged in trade or business. Now for the definition. For the citizen, the resident citizen or the RC is a citizen of the Philippines. That means he or she stays in the Philippines without the intention of transferring his physical presence abroad, whether to stay permanently or temporarily as an overseas contract worker. Now, for the other category, for the non-resident citizen or the NRC, a non resident citizen is a citizen of the Philippines who, number one, establishes the satisfaction of the CIR, the fact of his physical presence abroad with a definite intention to reside therein. Letter B, leaves the Philippines during the taxable year to reside abroad either as an immigrant or for employment on a permanent basis. Letter C, works and derives income from abroad and whose employment thereat requires him to be physically present abroad most of the time during the taxable year. Letter D, he has previously considered as a non-resident citizen and who arrives in the Philippines at any time during the taxable year to reside permanently in the Philippines. Letter E, taxpayer shall submit proof to the Commissioner of Internal Revenue to show his intention of leaving the Philippines to reside permanently abroad or to return to and reside in the Philippines. That is found in Section 22E of NIRC. Now for the another category for the aliens. First, the aliens or the resident aliens or RA. They are those individual whose residence is within the Philippines but who is not a citizen thereof. Now for another category, the non-resident alien or the NRA. The non-resident alien is an individual whose residence is not within the Philippines and who is not a citizen thereof. That definition can be found in Section 22G of NIRC. Now for the non-resident alien who is engaged in trade or business. The non-resident alien who is engaged in trade or business is an alien who stays in the Philippines for an aggregate period of more than 180 days. Now for the another category of non-resident alien of not engaged in trade or business is an alien who stays in the Philippines for 180 or less. Now for the special class or individual employees or the minimum wage earner. The special class of individual employees or the minimum wage earner refers to a worker in the private sector paid the statutory minimum wage or to an employee in the public sector with compensation income of not more than the statutory minimum wage in the non-agricultural sector where he or she is assigned. Now, for the non-resident alien who is not engaged in trade or business within the Philippines, they are being taxed for 24% final tax on their gross income from sources within the Philippines. But note, number one, they cannot claim any deductions because their tax is based on gross income. Number two, they are taxed at final tax rates. Number three, they are not required to file their income tax returns because their income is subject to final withholding tax. Now let's go to another subject, to another topic, the estates. The estates. The income that is subject to income taxation is the income received by the estate of the deceased person during the period of administration or settlement of the estate. That is found in Section 60A, Paragraph 3 of NIRC. Now for the income taxation of a resident estate. Income taxation of a resident estate. Number 1. Subject to income tax in the same manner as an individual citizen. Letter A. On all income received from all source. Letter B. Final tax on certain passive income except on distributable net income from partnerships and dividends, which are included in the taxable income. Capital gains from sale of shares of stock not traded in the stock exchange, and capital gains from sale of real property. Number 2. It shall be subject to the same manner as individuals, also to the same exclusions, itemized deductions, and tax rates. Letter A. Allowed to use the optional deduction. Letter B. In addition to the itemized deductions, it may deduct. Number 1. Amount of income for the taxable year distributed currently to the beneficiaries. Number 2. Amount of the income collected by the guardian of the infant, which is to be held or distributed as the court may direct. Number 3. Amount of income properly credited to the beneficiaries. And for the another category is for the allowed to deduct exemptions up to 20,000 pesos, which is found in section 62. Now for the income taxation of the non-resident estate. Same as the above, except that it may not be allowed to use optional deductions if not resident estate, because estate has no citizenship. Now, for the classification of trust. Number 1, taxable trust. Number 2, tax-exempt trust. For the tax-exempt trust, any part of the income of a trust which, in the discretion of the grantor, may be held or accumulated for future distribution to the grantor, or may apply to the payment of premium upon policies of insurance on the life of the grantor. Now for the revocable trust, distinguished from a revocable trust. The income of a revocable trust is included in computing the taxable income of the grantor without any of the deductions allowed for estates, while the income of an irrevocable trust is subject to tax as income to the trust after deducting the allowable deductions. Now let's go to the corporations. The term corporation shall include, number 1, partnerships, no matter how created and whether it is registered or not. Number 2, joint stock companies. Number 3, joint accounts or cuentas in participación. Number 4, associations or insurance companies. Here's a note, but the term does not include, number 1, general professional partnership, and number 2, a joint venture or consortium formed. Example, for the purpose of undertaking construction project and or the engaging in petroleum, coal, geothermal, and other energy pursuant to an operating or consortium agreement under a service contract with the government. Next is the co-ownership. The co-ownership are not deemed unregistered partnerships and therefore not taxable like corporation. Article 1769, paragraph 3 of the Civil Code provides that the sharing of gross returns does not of itself establish a partnership, whether or not the persons sharing them have a joint or common right or interest in any property from which the returns are derived. There must be an unmistakable intention to form a partnership or joint venture. and that the co-ownership as a rule is tax exempt, but when the heirs invested that inherited property in income producing activities, it becomes taxable and registered partnership. That is found in UNA versus CIR, JR number L-19342, May 25, 1972. Now for the income taxation of domestic corporation. The taxable for income from sources within and without the Philippines. Remember that a tax of whichever is greater of number 1, the normal income tax rate of 30%. Number 2, a minimum corporate income tax rate or MCIT of 2% of gross income as at the end of the taxable year, beginning on the fourth taxable year immediately following the year in which such corporation commenced its business. And that the optional taxation of 15% of gross income, and subject to the same final tax like resident individuals on their passive income, and that also the dividends received by a domestic corporation from another domestic corporation shall not be subject to tax. Now let's go to the MCIT, or the minimum corporate income tax. The nature and coverage of the MCIT. The MCIT is equal to 2% of the gross income of the corporation at the end of the taxable quarter, except income exempt from income tax and income subject to final withholding tax. The MCIT covers only domestic and resident foreign corporation which are subject to 30% normal corporate income tax. Hence, corporations which are subject to special corporate taxes do not fall within the coverage of the MCIT. For instance, a proprietary educational institution may be subject to a regular corporate income tax of 10%, depending on its dominant income, but it is exempt from the imposition of MCIT because the latter is not intended to substitute special tax rates. So is with PISA enterprises, CDA enterprises, etc. The question is when it is imposed. When it is imposed by a domestic corporation, when, number 1, it has zero or negative taxable income. Number 2, or when the amount of MCIT is greater than the normal corporate income tax of 30% due on taxable income. Therefore, the taxable due for the taxable year may be NCIT, the 30% of taxable income, or MCIT, 2% of gross income, whichever is higher. Now, for the rationale of MCIT, the Congress intended to put a stop to the practice of corporations which, while having large turnovers, report minimal or negative net income resulting in minimal or zero income taxes year in and year out through under declaration of income or over deductions of expenses, otherwise called tax shelters. The MCIT serves to put a cap on such tax shelters. As a tax on gross income, it prevents tax evasion and minimizes tax avoidance schemes achieved through sophisticated and artful manipulations of deductions and other stratagems. Since the tax base was broader, the tax rate was lowered. That is found in Chamber of Real Estate and Builders Association Incorporated versus Executive Secretary, JR number 160756, March 9, 2010. the relief from the MCIT, the Secretary of Finance is authorized to suspend the imposition of the MCIT on any corporation which suffers losses on number one, account of prolonged labor disputes where losses are incurred arising from a strike stage by the employees which lasted for more than 6 months within taxable period and which has caused the temporary shutdown of business operations. Number 2, because of force majeure. Number 3, because of business reverses. Now, here's a question. When shall MCIT commence? The following MCIT is imposed beginning on the fourth taxable year, immediately following the taxable year in which such corporation commenced its business operations. For purposes of MCIT, the business operations is deemed commence on the year in which the domestic corporation is registered with the BIR, regardless of whether the corporation is using the calendar year or the fiscal year. Now let's go to the carry forward of excess MCIT. The excess MCIT over the NCIT shall be carried forward and credited against NCIT for the 3 immediately succeeding taxable years. Any excess not credited in the next 3 years shall be forfeited. Note, the carry forward or annually or quarterly is possible only if the MCIT is greater than the NCIT. The maximum amount that can be credited is only to the amount of NCIT. There can be no negative MCIT. The MCIT is not violative of due process. Certainly, in income tax is arbitrary and confiscatory if it taxes capital because capital is not income. In other words, it is income, not capital, which is subject to income tax. However, the MCIT is not a tax on capital. The MCIT is imposed on gross income, which is arrived at by deducting the capital spent by a corporation in the sale of its goods. Example, the cost of goods and other direct expenses from gross sales. Now let's go to the MCIT is not an individual tax imposition. MCIT is not an additional tax imposition. It is imposed in lieu of the normal net income tax. Now let's go to the next topic. This is the improperly accumulated earning tax or IAET. I repeat, improperly accumulated earnings tax. Okay, it is 10% of the improperly accumulated taxable income. The IAET is imposed for each corporations retaining improperly accumulated earnings without distributing them as dividends to their stockholders. The purpose of the IAET is to curtail the practice of corporations in holding or retaining earnings without declaring dividends in order to avoid dividends tax for the stockholders. Now, the corporations not subject to the IAET. Number 1, publicly held corporations. Number 2, banks and other non-banks financial intermediaries. And number 3, insurance companies. Number 4, taxable partnership. Number 5, general professional partnership. Number 6, non-taxable joint ventures. Number 7, enterprises duly registered with PEZA or PEZA. Number 8, foreign corporations, including branch of foreign corporation. Those are the corporations not subject to improperly accumulated earnings tax. Now let's go to income taxation of foreign corporation. Number 1, the resident foreign corporation. Number 2, the non-resident foreign corporation. Okay, let's go to the resident foreign of corporations. The RFC, or the resident foreign of corporations, is 30% normal corporate income tax or 2% MCIT, whichever is greater, or option to be taxed at 15% of gross income. That is found in Section 27, or the statutory conditions for the applicability of optional taxation for corporations have not yet been met. In the second category, for the non-resident foreign corporations, or the NRFC in general, 30% final tax for all gross income from sources within. The taxation of resident foreign corporation in general, 30% of NCIT or 2% of MCIT, whichever is higher. Number 2 has the option to be taxed at 15% gross income. That is found in Section 27 of statutory conditions have not yet been made. Number 3, subject to tax on branch remittances, or the 15% based on total profits applied or earmarked for remittances without any deductions for the tax component thereof, except activities registered with PISA. Number 4, subject to the same final tax like domestic corporations, or Section 28A, paragraph 7. Not subject on capital gains tax from sale, exchange, or disposition of land, buildings. Thus, such is part of income tax, whether ordinary or capital gains. Number 5, dividends received from a domestic corporations shall not be subject to income tax. Next is kinds of partnership and their taxation. Letter A, taxable partnership. And letter B, general professional partnership. First, let's go to letter A, taxable partnerships. The partnership is subject to taxation like a corporation. The distributive share of each partner is subject to final tax under Section 24B, paragraph 2, and is no longer needed to be reported as part of their taxable income. The final tax rate on distributable income of a partner who is a citizen or non-resident alien is 10% and 20% if NRAETB. In the second category of the general professional partnership, the partnership is not subject to income tax. That is found in Section 26. The partners are liable for income tax only in their separate and individual capacity. I repeat, the general professional partnerships are the partnerships are liable for income tax only in their separate and individual capacity, because that kind of partnership is not subject to income tax. Each partner shall report as gross. Each partner shall report as gross income his distributive share actually or constructively received in the net income of the GPP. That is found in Tan versus Del Rosario. Income payments to the partners shall be subject to creditable withholding tax of 15% if the gross income in one taxable year extends 720,000 and 10% if otherwise. Note, if the GPP avails of itemized deductions in computing its net income, the partner may claim itemized deductions in computing his taxable income. However, if the GPP avails of optional standard deduction, The partners can neither claim itemized deduction nor OSD in computing his taxable income. Now, for the next topic, the sources of income subject to tax. Tax treatment for forgiveness of indebtedness. Number one, when cancellation of debt is income. If an individual performs services for a creditor who, in consideration thereof, cancels the debt, it is income to the extent of the amount realized by the debtor as compensation for his services. Number two, when cancellation of debt is a gift, if a creditor merely desires to benefit a debtor and without any consideration therefore cancels the amount of the debt, and it is a gift from the creditor to the debtor and need not be included in the latter's income. Number three, when cancellation of debt is a capital transaction, if a corporation to which a stockholder is indebted forgives the debt, the transaction has the effect of payment of a dividend. Number four, an insolvent debtor does not realize taxable income from the cancellation or forgiveness. Number five, the insolvent debtor realizes income resulting from cancellation or forgiveness of indebtedness when he becomes insolvent. Now, for the next topic, the recovery of accounts previously written off or recovery of bad debts. This rule states that the recovery of bad debts previously allowed as deduction in the preceding year of years shall be included as part of the taxpayer's gross income in the year of such recovery to the extent of the income tax benefit of said deduction. The recovery of amounts deducted in previous years from gross income become taxable income unless to the extent thereof the deduction did not result in any tax benefit to the taxpayer or in a reduction of income tax liability. If the taxpayer did not benefit from deduction, the bad debt written off, the subsequent recovery thereof shall be treated as a mere recovery or a return of capital. Next, the compensation income. The compensation income, it includes all remuneration for services rendered by virtue of an employer-employee relationship unless specifically excluded under the NIRC. Now for the requisites for taxability of compensation income. Number one, personal services actually rendered. Number two, payment is for such services rendered. Number three, payment is reasonable. I repeat, for the requisites for taxability of compensation income, number one, personal service actually rendered. Number two, payment is for such services rendered. Number three, payment is reasonable. Next is the interest income. The interest income from long-term deposit or investment in the form of savings, common or individual trust funds, deposit substitutes, investment management accounts, and other investments evidenced by certificates in such form prescribed by the BSP is subject to the following rates, and this applies to RC, NRC, RA, and NRAETB. Held for 5 years or more, that is exempt. 4 years to less than 5 years, that is 5%. 3 years to less than 4 years, that is 12%. Less than 3 years is 20%. Now, for the tax dividend, the general rule is that
tax dividends, strictly speaking, represent capital and do not constitute income to its recipient. So the mere issuance thereof is not subject to income tax, as they are nothing but enrichment through increase in value of capital investment. But here's an exceptions. There are four exceptions to this stock dividend. Number one, these shares are later redeemed for consideration by the corporation or otherwise conveyed by the stockholder to the extent of such corporation. Number two, the recipient is other than the shareholder. Number three, if the stock dividend issuance resulted in a change in the shareholder's equity. Note, a stock dividend does not constitute taxable income if the new shares did not confer new rights nor interest than those previously existing, and that the recipient owns the same proportionate interest in the net assets of the corporation. Number four, stock dividends, which is equivalent to cash or property, resulting in change of ownership and interest of the shareholder. All right, for the next topic is the fringe benefit tax. The fringe benefits is any goods, services, or other benefit furnished or granted by an employer in cash or in kind in addition to basic salaries to an individual employee except a ranked and file employees. That definition is found in Section 33B of the NIRC, Section 233B of the Code. Next is the special treatment of fringe benefit. Okay. For the recipient, they are the ranked and file employees. And for the tax treatment, is the value of such fringe benefit shall be considered as part of the compensation income of such employee subject to tax payable by the employee, and that is found in Section 33 of NIRC. Now, for the recipients of managerial and supervisory employees, the tax treatment is it is not part of the compensation income of the recipient but is subject to final tax on the grossed up monetary value of fringe benefits furnished or granted to the employee to the paid by the employer. The fringe benefit is instead levied upon the employer who is required to pay. Now, for the next topic is the taxable fringe benefit. The taxable fringe benefits is any goods, services, or other benefit furnished or granted by an employer in cash or in kind in addition to basic salaries to an individual employee except a ranked and file employee are taxable fringe benefit. Now for the non-taxable fringe benefit is letter A, fringe benefits which are authorized and exempted from tax under the special laws. Letter B, contributions of the employer to the benefit of the employee to retirement, insurance, and hospitalization benefit plans. Letter C, benefits given to ranked and file employees, whether granted under a collective bargaining agreement or not. Letter D, that is de minimis benefits, as defined in the rules and regulations to be promulgated by the Secretary of Finance under recommendation of the CIR. Note, the amount of benefits exceeding their respective ceilings shall be considered as part of other benefits under Section 32B 7E of the NIRC. But under 32B 7E of the NIRC, the 13-month pay and other benefits are excluded from gross income, provided that they do not exceed 82,000 pesos. Any excess thereof is considered part of the compensation income of an individual. Hence, it is subject to income tax. And for the letter E of the non taxable fringe benefit is when the fringe benefit is required by the nature or necessary to the trade, business, or profession of the employer. Letter F. The employer's convenience rule is when the fringe benefit is for the convenience of the employer. Now, for the topic of convenience of the employer rule. Okay, the French benefit shall not be taxable if, letter A, it is furnished in the employer's business premises. Letter B, the employee is required to accept such lodging as a condition of his employment. Now let's go to the housing privilege under the French benefit tax. The housing privilege subject to the French benefit tax is number one, employer leases residential property for use of the employee. Number two, employer owns a residential property and assigns the same to the use by the employee. Number three, employer purchases a residential property on installment basis and allows use by the employee. Number four, employee purchases a residential property and transfers ownership to the employee. Number five, the employee provides a monthly fixed amount for the employee to pay his landlord. And now let's go to another topic, the housing privileges exempted from the French benefit tax. Okay, number one, housing privilege of military officials of the Armed Forces of the Philippines is consisting of officials of the Philippine Army, the Philippine Navy, and Philippine Air Force. The rationale is that state shall provide its soldier with a necessary quarters which are within or accessible from the military camp so that they can readily be on call to meet the exigencies of their military service. Number two, a housing unit which is situated inside or adjacent to the premises of a business or factory, provided that it is located within the maximum of 50 meters from the perimeter of the business premises. Number three, temporary housing for an employee to stay in a housing unit for 3 months or less. Note that uh, letter A, the monetized unused vacation leave credits of the employee is for the private employees should be the vacation leave exempt up to 10 days. Now for the sick leave is always taxable. And for the government employees, the vacation and sick leave are always tax exempt, regardless of the number of days. And letter B, monetary value of books and flowers are now taxable. Letter C, the ceiling for uniform and clothing allowance increased to 5,000 a year from 4,000 of the previous years. And letter D, the rice allowance or the 1,500 per month or one sack of rice of rather 50-kilogram rice per month amounting to not more than 1,500. Next topic is the exclusions from gross income. The exclusions from gross income are not included in gross income and exempt from income taxation. Proceeds of life insurance. That is number one. Proceeds of life insurance received by the heirs or beneficiaries upon the death of the insured constitute a compensation for the loss of life, hence a return of capital which is beyond the scope of income taxation. That is found in section 32B, paragraph 1 of 1997 tax code. Note, if such amounts are held by the insurer under an agreement to pay interest thereon, the interest payment shall be included in gross income. Number two, Amount received by insured as return of premium. Because under life insurance, endowment, or annuity contracts, either during the term or at the maturity of the term mentioned in the contract or upon surrender of the contract. Note, the amount returned is not income but mere capital or return of capital. I repeat, the amount returned is not income but mere return of capital. Now let's go to the return of premium versus life insurance proceeds. There's big difference of the two. Now, the difference lies in case where the insured in a life insurance contract survives. In order that a life insurance proceeds may be totally exempt from income taxation, the insured must die. If he survives, there is only a partial exemption. Example, only a portion of the proceeds representing return of premium or premiums previously paid is excluded, being a mere return of capital. I repeat, the return of premium versus the life insurance proceeds. The difference lies in cases where the insured in a life insurance contract survives. In order that a life insurance proceeds may be totally exempt from income taxation, the insured must die. If he survives, there is only a partial exceptions. Example, only the portion of the proceeds representing return of premiums previously paid is excluded, being a mere return of capital. Okay, number three for the exclusions from gross income is the gifts, bequests, and devices. The value of the property acquired by a gift, bequest, device, or descent. Note that the income from such property shall be included in the gross income, but it is an exclusion from the gross income. Now, for the gift tax test, when a person gives a thing or right to another and it is not a legally demandable obligation, then it is treated as a gift and excluded from gross income. However, if there is a legally demandable obligation to give, such as for services rendered by one to the donor or due to his merits, the amount received is taxable income to the recipient. Number four, for the exclusion from gross income. Number four is the compensation for injuries or sickness, and plus the amounts of any damages received, whether by suit or agreement or account of such injuries or sickness. Note, they are mere compensation for injuries or sickness suffered and not income. It is intended to make the injured party whole as before the injury. So, they are exclusions from gross income. And for the fifth one is the income exempt under treaty. The income of any kind to the extent required by any treaty obligation binding upon the government of the Philippines. Note, the public policy recognizes the principles of reciprocity and comity among nations. The reasons for granting tax exemption through a treaty is that number one, because of reciprocity. Number two, to lessen the rigors of international juridical double taxation. And especially, don't forget the most favored nation clause. The most favored nation clause, this grants to the contracting party treatment not less favorable than which has been or may be granted to the most favored among other countries. It allows the taxpayer in one state to avail of more liberal provisions granted in another tax treaty to which the country of residence of such taxpayer is also a party. provided that the subject matter of taxation is the same as that in the tax treaty under which the taxpayer is liable and paid under similar circumstances. That is found in CIR versus SC Johnson and Son Incorporated, JR number 127105, June 25, 1999. Now for the number six of the exclusions from gross income, the retirement benefits, pension, gratuities, etc. The retirement benefits received under Republic Act number 7641 and those received by officials and employees of private firms, whether individual or corporation, in accordance with a reasonable private benefit plan or the RPBP, reasonable private benefit plan, maintained by the employer. Here's the requisites for that. Number one, the RPBP must be approved by the BIR. Number two, the retiree must have been in the service of same employer for at least 10 years at the time of the retirement. Number three, the private employee or official must be at least 50 years old at the time of his retirement. Number four, the benefits under the RPBP must have been availed for only once. Note, once the benefits under the RPBP have been availed of, the retiree can no longer avail of the same exemption for the second time under another RPBP but can avail exemptions under other grounds such as SSS or GSIS benefits. And letter A, for the GSIS and SSS benefits. Letter A, retirement benefits in the absence of a reasonable private benefit plan maintained by the employer. Number one, where the retirement plan is established in CBA or other applicable employment contract. Any employee shall be retired upon reaching the retirement age established in the CBA or other applicable employment contract. Number two, in the absence of the reasonable private benefit plan or agreement providing for retirement benefits of employees in the establishment. Letter A, optional. The conditions are the employee, upon reaching the age of 60 years or more. Number two, who has served at least 5 years in said establishment. Number three, may retire and shall be entitled to retirement pay equivalent to 1/2 month salary for every year of service, a fraction of at least 6 months being considered as one whole year. And letter B, for the category of mandatory. In mandatory, the conditions are number one, an employee upon reaching the age of beyond 60 years, which is in the compulsory retirement age, because in optional that is only reaching the age of 60, while in mandatory, uh, the employee upon reaching the age of beyond 65 years, which is the compulsory retirement age. Number two, who has served at least 5 years in the said establishment. Number three, may retire and shall be entitled to retirement pay equivalent to 1/2 month salary for every year of service, a fraction of at least 6 months being considered as one whole year. That is found in RA 7641, the Retirement Pay Law. Now, for the other benefits of the GSIS and SSS, letter B, is the separation pay due to death, sickness, or other physical disability or for any cause beyond the control of the official or employee. Number Letter C, for the social security benefits, retirement gratuities, pensions, and other similar benefits received by the resident or non-resident citizens from foreign government agencies and other institutions, private or public. Letter D, benefits from the United States Veterans Administrations. And letter E, SSS and GSIS benefits. Now let's go to number 7 of the exclusions from gross income. Number 7 is the miscellaneous items. There are 1, 2, 3, 4, 5, 6, 7, 8. Okay, letter A. For the miscellaneous items, letter A, income derived from investments in the Philippines in loans, stocks, bonds, or other domestic securities, or from interest on deposits in banks in the Philippines by number 1, foreign governments, number 2, financing institutions owned, controlled, or enjoying refinancing loan from foreign governments. Number 3, international or regional financial institutions established by foreign governments. Letter B, income derived by the government or its political subdivisions from any public utility or from the exercise of any essential government functions. Letter C, prizes and awards. Number 1, for the prizes and awards, number 1, in recognition of religious, charitable, scientific, educational, artistic, literary, or civic achievements. Number 2, the recipient was selected without any action on his part to enter the contest or proceeding. Number 3, the recipient is not required to render substantial future services as a condition to receiving the prize or award. Letter D, prizes and awards in sports competition. And in this category, number 1, granted to athletes in local and international sports competitions and tournaments. Number 2, whether held in the Philippines or abroad. Number 3, sanctioned by their national sports associations. Letter E, the 13-month pay and other benefits such as productivity incentives and Christmas bonuses not exceeding 82,000 pesos. That is found in RA 10653 and implemented by RR 3-2015. And letter F, GSIS, SSS, Medicare, pag-ibig, and other contributions or union dues. Letter G, gains from sale, exchange, or retirement of bonds, debentures, or other certificate of indebtedness with a maturity of more than 5 years. And letter H, gains from redemption of shares in mutual fund. So those are listed in miscellaneous items. Number 1, I repeat, income derived from investments in the Philippine loans, stock bonds, or other domestic securities, or from interest in deposits in banks in the Philippines. Letter B, income derived from government or its political subdivisions, from any public utility, or from the exercise of any essential government functions. Letter C, prizes and awards. Letter D, prizes and awards in sports competition. Letter E, the 13-month pay and other benefits such as productivity incentives and Christmas bonuses not exceeding 82,000 pesos. Letter F, GSIS, SSS, Medicare, pag-ibig, and other contributions or the union dues. Letter J, gains from the sale, exchange, or retirement of bonds, debentures, or other certificate of indebtedness in a maturity of more than 5 years. Letter H, gains from redemption of shares in mutual fund. So I repeat for the list of exclusions from gross income. Number 1, exclusions from gross income. Number 1, proceeds of life insurance. Number 2, amount received by insured as return of premium. Number three, gifts, bequests, and devices. Number four, compensation for injuries or sickness. Number five, income exempt under treaty. Number six, retirement benefits, pensions, gratuities, and etc. And number seven, the last one is the miscellaneous items. And that would be all for the part two of our taxation law, and I will be back for the part three.
Thank you so much for listening. I do hope I contributed something to help your criminal law review for the Philippine bar exam. I am doing this reading or audio to help also myself as I am struggling with my focus in reviewing the bar exam. I really find it hard to study, especially reading these notes, so I decided to make this video so that even if I am doing something or I am in public places, I still be reviewing the bar in my earphones. If you want also a copy of my reading audios, please send me a message, or if you want me to read some other bar reviewers in my email ad, sender5681 at gmail.com, or to my Facebook page, sender5681. It would be a pleasure to help others while I am reviewing for the bar exam, and I am so happy to share these things to my fellow bar candidates. Thank you so much, and God bless.